Hey everyone, welcome to this explainer. Look, if you've been glancing at the tickers today, you already know it's one of those days, the kind that just demands your attention right away. We're seeing some serious, sudden market volatility out there. So my goal for us today is to completely demystify what's actually happening on the trading floor. We're going to look past all those flashing red numbers and really unpack the actual mechanics behind today's market plunge. Let's just dive right in. 830 points. Seriously, it's the sheer velocity of this drop that really stands out. Right out of the gate in early trade, the Sensex just plummeted by over 830 points, dragging it all the way down to 76,578. To put that in perspective, that is a massive 1.07% haircut, literally right at the opening bell. When you see a drop of that magnitude so early in the day, well, it tells you there's some heavily concentrated selling pressure at work. This isn't just a slow bleed, it's a rapid, aggressive recalibration by investors. Now, to really wrap our heads around this, we need to pivot from the macro index level down to the micro sector level, because it's a tale of two markets right now. On one side, you've got the nifty IT index taking an absolute beating, down a massive 6.44% in early trade. Ouch, right? But then, on the flip side, we're actually seeing some really surprising green shoots. Sectors like defense, pharma, media, and energy, they're proving to be incredibly resilient. They're holding their ground, and some are even trading in the green. So what this tells us is that the panic isn't some total market washout. It is highly concentrated. So, to make sense of all this chaos, here is what we are going to look at today. Number 1, the big market plunge. Number 2, the IT sector sell-off. 3, thin global trade. 4, Middle East tensions. And finally, number 5, the broader market picture. All right, let's start with section 1, the big market plunge, scale of the drop. Okay, check this out. The IT sector accounts for only about 8.5% of the total weight in the Nifty 50 index. The other 91.5% is literally everything else. Your banks, autos, consumer goods. Yet despite being such a tiny slice of the overall pie, this intense sell-off in IT acted like a massive anchor today. It was so severe that it dragged the entire Nifty benchmark down by more than 120 points, settling right around 23,938. That's nearly a 1% drop. It's honestly a perfect textbook example of how a sharp shock in just one specific sector can disproportionately rattle the entire broader system. Which brings us to the million-dollar question. Why? Why exactly is the market crashing today? We've seen the data, we know IT is the main culprit pulling the strings here, but what was the actual trigger? Well, it's time to put on our detective hats and uncover the root causes, both domestic and global, that all collided to create today's intense sell-off. Moving on to section 2, IT sector sell-off, domestic catalysts. Okay, so it all really started with this, Accenture cutting its revenue outlook. For those who might not follow them closely, Accenture is a massive global consulting and tech services giant, and they pretty much act as a bellwether for the entire tech industry worldwide. They just released their guidance, and get this. Despite reporting totally healthy profitability, they actually went ahead and cut their revenue outlook for the current quarter. Naturally, that weaker-than-expected guidance immediately disappointed global investors. But the real kicker for us? It sparked some very deep fears about the demand trends for Indian tech companies. I mean, if a global giant is seeing a sudden slowdown in client spending, the immediate fear is that Indian IT firms are going to feel that exact same pinch. And wow, did that fear cause some widespread damage across the frontline IT stocks today. Infosys really led this devastating decline, just plummeting by 8.01%. Emphasis wasn't far behind either, dropping 6.10%. And even the heavyweight TCS fell by 5.84%. Oh, and the pain definitely did not stop there. Tech Mahindra and HCL Technologies also took some heavy hits, both losing over 5%. What you're seeing here is a direct, aggressive reaction. Investors are rapidly repricing these stocks based on a potentially much weaker outlook for the whole sector. Next up, section 3, thin global trade, low trading volumes. Now, this right here is a really vital piece of the puzzle. Global trading activity has been incredibly thin today. Why? Because major markets in both the US and China are completely closed. So why does that matter to us? Well, when those financial behemoths are offline, overall market participation across the major asset classes drops off a cliff. There's just way less money sloshing around the system. And you know how financial markets work. When trading volume is that low, any sudden buying or selling pressure, like the panic we just talked about in IT, gets massively amplified. Thin trade basically acts like a magnifying glass for local volatility, making these market swings so much more exaggerated than they'd be on a normal, fully staffed day.
Now for Section 4, Middle East tensions, geopolitical fears.
Geopolitics is definitely playing a major role today, too. Investors are keeping a very, very close watch on the Middle East right now. We're seeing source reports of a ceasefire breach in Lebanon. According to those reports, Israeli drone strikes hit 2 vehicles in the town of Mayfadoun, and there was a completely separate strike reported in nearby Shaukin, resulting in at least 4 deaths. Now, what's really rattling the markets here is the timing. These attacks occurred despite that recently established ceasefire agreement, which was supposed to cool things down along the border. So naturally, this is raising some very serious, fresh concerns for global investors about whether this truce is actually durable, and the stark risk of renewed, broader hostilities in the region.
And look, as we all know, geopolitical tension doesn't just stay on the news channels. It hits the global economy, and ultimately it hits your wallet. Thanks to these fresh worries out of the Middle East, we're seeing Brent crude oil prices reacting instantly. They are already inching their way back up toward that $80 per barrel mark. And whenever oil prices threaten to spike, it immediately stokes fears of inflation and higher operating costs for businesses pretty much across the board. Add that to the mix, and you've got even more downward pressure weighing on the stock market today. Finally, let's look at Section 5, the broader market picture, looking beyond IT.
So when we actually pull our focus away from the large cap Nifty 50, the broader market is painting a really fascinating mixed picture. Yes, the Nifty Midcap 150 did drop, but only by about 0.26%. That is nowhere near the 1% tumble we saw on the main index. And here's the really interesting part. The Nifty Small Cap 250 actually managed to rise by 0.17%, right in the middle of all this chaos. What does that tell us? It means that even while the massive IT giants were dragging the main index through the mud, traders are still out there finding value. They're actively participating in smaller, perhaps more domestically insulated companies. Which honestly leaves us with the ultimate question. Is this just a temporary blip, driven by one specific sector's earnings and a low-volume trading day? Or are we looking at the start of a much deeper correction, fueled by fragile global truces and shifting tech demand? The market is such a complex living ecosystem, isn't it? Today brilliantly illustrated how a single corporate announcement from Accenture, colliding with closed global markets and geopolitical friction, can whip up an absolute perfect storm. So keep watching those IT demand trends, definitely keep an eye on crude oil, and most importantly, keep learning. Thank you so much for joining me for this explainer, and I really look forward to decoding the next market move with you.